What is up, everybody? Today we're going to be doing the second video on my series Bankrupt or 10X. And today we're going to be looking at a company, Cumulus Media Inc., ticker symbol CMLS, currently trading at $2 a share, hit a high of 15 with a market cap of 37 million. I also want to state when I start this video, because these stocks are highly risky and they could go bankrupt. So I just want to say this is not financial advice, and this company could easily go to zero in the upcoming year, or well, whenever. So let's get right into the video, and I just wanted to add a disclaimer. Alrighty, guys, so I pulled up my Excel file. It would not be a stock video without an Excel file. So let's get right into it. So first thing I want to talk about, guys, for the new people here, and if you guys don't know the basics of bankruptcy, there's multiple different types of bankruptcy. But when we're talking about stocks, or corporations in particular, most of the time these companies are going to be filing two main types of bankruptcy, and that is Chapter 7 bankruptcy and Chapter 11 bankruptcy. Now, if you don't know what Chapter 11 and Chapter 7 bankruptcy is, Chapter 7 bankruptcy is basically where they liquidate the company and close down. And the creditors get paid whatever, and the company just shuts down. Now, the main one that most of these companies file is Chapter 11 bankruptcy. Now, if you don't know what Chapter 11 bankruptcy is, it is basically where all debt payments are paused, and they go to bankruptcy court and negotiate to try to come out the other end as a better company. And in both of these occasions, 99% of the time, shareholders get wiped out. So that's what happens most of the time. Now, you do see outliers, like Tuesday Morning was one, and Hertz is two that I can think of on the top of my head. And when we're looking, now those are the two main types. Now, when you're looking at bankruptcy risk, there is basically three things you want to check. And that is current assets, current liabilities, and liquidity. Those are the three things that you want to see. Okay, so if we look at this company, this is their balance sheet, guys. Don't get it, don't complicate it. But we can see that they have 276 million of current assets, and they have 139 million of current liabilities. So they almost have 2x the current assets than liabilities, which, if you don't know, that's a really good sign, because that shows that they could probably pay these current liabilities off. And if you're not sure what a current liability is, a current liability is basically a liability that needs to be paid within a year. It could be a debt payment, it could be, current it could be anything like that. But if you don't pay your debts, your liabilities, then obviously you go bankrupt. So this company does have enough current assets, to pay it off. So do I see them filing Chapter 7 bankruptcy this year? No. That's I'm kind of surprised too, but we'll get more into that later. And now let's talk about like these assets and their bond rating and everything else. I mean, okay, if we look at the insider ownership, it's 17%, which that's huge insider ownership. That's what you kind of want to see, because that will obviously kind of, management's kind of in the headset of our mindset of not filing bankruptcy and wiping shareholders out, because they have some skin in the game too. Their bond rating is B minus, and sometimes on S&P Global, from what I've seen, is they even have like a default risk too. So this company is, they're obviously the bond rating is showing that this company is probably going to default or go bankrupt. But the thing that doesn't make sense to me is this company looks fine with the current assets and the current liability. That's what doesn't make really any sense to me, is like they just got out of Chapter 11 bankruptcy too. Like, we're talking in 2018, they just got out of Chapter 11 bankruptcy. So I'm just kind of confused with this one. But let's just keep going. Let's just talk about risk with these assets. Okay, let's talk about these account receivables. Now, accounts receivables, I looked it up. Most of these accounts receivables are from multiple different customers, so you don't have that risk of a customer going bankrupt and some of these accounts receivables, going to zero. They didn't really list any of that in the SEC filings when I was reading them, because they only said one thing, and it is that their customer base is very diversified, between multiple different cities, 80 cities. So there's not really much of that risk, but I just put, a regular, 20%, let's say 20% of them go to zero, as being conservative. Obviously, trade receivables didn't do anything. I don't see any risk with these, but most of the time, most of these current assets are fine. $68 million in cash, it looks pretty good to me. And I put that as their liquidity. $68 million is their liquidity. I didn't add any of the debt that they could get, credit lines, but so they have $68 million worth of liquidity. So I don't really see much risk with that. If we go down to their long-term assets, the only risk with these is these intangible assets, and mostly are trademarks and relationships, which I took it off because why are these relationships worth $91 million, and these trademarks worth that much? So that's another thing too. They could possibly be, valued at fair value, but I took that off. Another thing with these, obviously, when we're looking at broadcasting companies, companies like cable or anything, they're gonna have a lot of intangible assets. So broadcasting licensing is also an intangible asset, but obviously they're worth something because they are rights to a radio station or whatever, and those radio stations make money for advertising. But nothing really came out to me, and I'm like, okay, this is terrible. There's this company looks like it's about to go bankrupt. Nothing really showed me that. Um, the only thing they did is, they are losing money right now. So that is another thing, which we'll get into later. But they had $1.4 billion worth of assets. So total assets, $1.4 billion. And their liabilities, let's talk about these liabilities that they have. I'm going to skip over current liabilities because obviously they have enough to pay their current liabilities. There's, no question about that. These long-term liabilities, and these are the two main things that we want to talk about, is the 2026 loan that they have. And we can see here it's due on March 2026, or it's the year 2026, March 31st. So they have a long time until it matures. It is a 9% interest rate, or per annum, and it is in total $328 million in debt. So that will mature 2 years from now. Actually, I think a year and a half from now. But one thing they did do with these senior notes, I'd like to talk about too, is that they push these senior notes out to 2029. And we'll get to that when we talk about the earnings call. But, I don't see a point where this company in the next year files Chapter 7 bankruptcy. And kind of calculating Chapter 11 bankruptcy risk, I don't know. I just can't. I don't know why they would file Chapter 11 bankruptcy, because these 30, pushing maturities out of these two debts are not the 2026 one. But when this matures, this could possibly put this company into that Chapter 11 position to file again. But they're probably going to have to figure out a way to push this out to 2029. And if they can't do that, then they're going to be in big trouble. But yeah, they have 344 million of these senior notes. Obviously, this is going to be pushed out to 2029, and that interest rate did go up to 8%. These are just notes while I was reading the SEC filings. But and if we do assets minus liabilities, we get $272 million. So that's their total, basically positive equity there. And then if you obviously subtract accumulated deficit, which if you don't know what that means that the company has negative retained earnings. So the company has not made money, in its lifetime. And if you subtract that, they have shareholders' equity of 236 million. Now there was one risk with the stock. They could issue 100 million shares of both Class A and Class B at a par value of 0.0001. So they could just issue a bunch of stock if they wanted to. This company doesn't really have a history of issuing stock, so that could I don't know if that could happen, but if something happens, like a takeover or something like that, they could easily do that. But they have a lot of shares they could issue. So that is one risk too, that we should take into account, is share issuance or stock issuance. So that is one risk. And then also I want to go over to another screen which shows the competitors. Like the whole radio industry is basically selling cheap. And we could look at all these companies, right? So BBGI, GTN, SGA, all these companies are basically their competitors. And I thought it would be like a cool, a good thing to compare and contrast these two, because we could see how these stocks are trading. So we have BBGI. So if you go assets minus liabilities, they have 149 million of positive equity in their stock still, um, and their market cap is 20 million. It's just crazy. Some of these stocks are trading so cheap, and it's probably because they do have a lot more debt than assets. Which, when you're in a rising interest rate environment, these companies that have a bunch of debt, let's say they were paying 6%, getting a 6% interest rate, a year ago, 2 years ago, when interest rates were like near zero. Now they're gonna get 9-10%. So a lot of these interest rates are gonna go up, but this company, BBGI and CMLS, might as well be trading at the same price, and it was at one point, which is pretty crazy. Um, because BBGI has 149 million assets minus liabilities, so it's just crazy. So I'm looking at this. GTN 556 million has 2.7 billion in assets minus liabilities. Um, so it's just pretty crazy what's going on in this industry, and I felt like this kind of gives you a good idea of what's happening. Urban One. You know, I mean, and then here's the current ratio. If you don't know what current ratio it is, basically current assets divided by current liabilities, and they all have pretty good current ratios too. So most of these probably will not go bankrupt within a year. You know, now if these companies continue to lose money, then of course they're going to go bankrupt. And let's go back to CMLS. Okay, so the EPS next quarter is expected to be negative 34 cents to negative 54 cents. So they are expected to be unprofitable. And I think, from looking at earnings projections on Yahoo, that one Tipsy, I forget what it's called, but most of them are expecting them to have negative EPS for 2 years, which that is not good, especially when you're going to have a huge, maturity of your bonds, of your debt. Um, so that's not good. Because if this company continues to lose money, then I could easily see them doing that route and filing bankruptcy. And that's why, when I put my odds of bankruptcy, I have a 40% odds of bankruptcy. And if they keep losing money for 2 years, I put that odds up to 80 to 100%. They will 100% go bankrupt if that continues to happen. Especially, with these, the new maturities. It's just it's not looking good for this company. And then for you know So that's what I'm kind of worried about, guys. And if we look at the earnings call, it was a very short earnings call, but these are some things that I found. Most the important stuff. They secure obviously the thing I was talking about with maturities. They secured 5-year maturities with very favorable terms. Let's go down. Extended maturities to 2029. So that is good. They're extending those. Another thing is we can see here that some of their stream to our management, our NCAA streaming rights. We increased our streaming affiliates by almost 60% during March Madness in the Final Four run. So they are getting, the business is growing, but I think their main part of the business has dropped like 2%. But obviously, radios and the radio business is not doing, who the hell listens to the radio? Boomers. That side of the business is, obviously declining. The radio business is declining, and people are going to advertise on like a Facebook or an Instagram, something more efficient. Not many people listen to the radio anymore. Um, and we can see here that they, all this other stuff. And another thing too is, like, I was thinking in my head, like, oh, obviously the campaigns are coming up for 2024. So they should get a lot of revenue from, political ads and stuff like that. But obviously, they said in the earnings call that the demand is way different from 2020. Down 55% from 2020. So they aren't seeing that huge spending to get Joe Biden into office. It is like the same exact election, but it's much different now. So we're not seeing the huge spending for those political ads. So that could be also kind of bad for them too. Revenue Q1, yeah, 200 million. It was down, not good. Obviously, radio business is declining. Ads for the radio business is declining. And another thing, analysts asked a question about the business and about next quarter. And one thing they did say is that but it's too early to tell. So the national market continues to be pretty lumpy, but when you have to look at what we have on the air, sports, non-sports, and local pacing improvement through the month, these are factors that we'll just have to see in the next 2 months. So he did say it's looking pretty lumpy still. So are they going to come back and they're going to have negative earnings again, which everyone's projecting? Because at this company, now let's go. I'm kind of skipping all over the place. I should kind of organize this video, but we're coming to the end now. And now let's start talking about the upside. Okay. So obviously it's trading at a $2.03 stock price, $34 million market cap. It has very low short interest, so there's not a lot of shorts around, which I'm surprised about when you have B minus bond rating. So people aren't seeing that this is going to go bankrupt. Obviously, you know, and that also could be also why not a lot of people are shorting is because it's already priced in, which that's what we're seeing. But here's my upside price. $6.57. That's if you take off the intangible assets and do the basically fair value of those assets is $6.57. But if you do nothing and just leave it how it is, the upside is about $14 a share. And that gives you about a 224% upside or a 591% upside. And obviously the downside, if it does go bankrupt, is 100%. So is it a gamble? It is a gamble, and that's why I tell you guys in this video, do not sue me if it goes down, okay? You could, don't blame me. All I did was the research. In these videos, there will be times where they age terribly, and there will be times where they age pretty well. But most of the time, they're probably going to age terribly. But these are my odds of bankruptcy: 40% because of them losing money. And that's basically it. Them losing money, and also the talks of Chapter 11 bankruptcy. I just honestly, look, this is just me. I don't know why a company would file Chapter 11 bankruptcy when they just got out of Chapter 11 bankruptcy in 2018. And the maturities of these bonds are in 2026. Do I see them filing bankruptcy this year? I think I should and I'd probably put that at a 20 to 30% chance because I don't see a point where they file bankruptcy. It just doesn't make sense to me. It honestly just does not make sense. So this is a gamble. And this will officially be the end of the video, guys. Please like and subscribe. People seem to be liking my Big Lots video. So go check that one out if you want to watch another one of these videos. But